Scott, Wren, what do you make of today's market action, the way that we have taken in what happened with CPI after this nice rally?
Well, Mike, I tell you, I think certainly the CPI number was good. It was better than expected. I don't think the market has a lot of faith that we're not going to see at least a little bit higher inflation. We certainly think we will. So I think after the big bounce that we've had, we're above the 200-day moving average. We've crossed through some other prior resistance. And so we've had a good run here. It makes sense to me that we'd be a little choppy up here because, if you let's face it, I mean, stocks aren't cheap. And if you're a technician, really the next level up here is the record high. And so with all the things going on, the economy slowing, earnings growth likely to slow, lots of trade negotiations to still work through, is there really a good reason to take a run at the record high? I don't know about that. It makes a lot of sense to me that we'd be choppy and maybe see a little downside here.
Yeah, of course, that record high in the S&P 500 is up about 2% from here, getting a little bit close, not to maybe make a try for it at some point, although I guess you still feel as if we might have a little bit of a stagflationary impulse. In other words, a little bit of a growth slowdown, and then you have some stickiness in inflation from here. And I guess, what does that tell you to do as an investor?
Well, right now, Mike, what we're doing, our really midpoint of our target range for year-end this year is 6,000. So, I mean, we're there. We're a little bit ahead of that. So I think, we cater to retail investors. They tend to be dollar cost averagers. I mean, if they're dollar cost averagers, that's fine. You can probably still do it. But what we really want them to do, and we had the opportunity when the S&P was down 10+%, is step it up. And so, we took money out of bonds in the pullback that we had. We took money out of bonds. We put it into stocks. We're overweight large cap. We're overweight mid caps. And so I think that if we had another opportunity, we'd probably boost that bet. But, we're trying to think ahead. We think the economy is going to be slow the next couple of quarters. We want to try to position ourselves for what we think is going to be a better economy, not just here in the States, but abroad as we cross into 2026. So, we've liked things like tech and communication services. We like financials. We've liked energy, but which has been a little tougher, obviously. Today's good, but a little tougher. We like actually utilities, which I think has some defensive and some offensive qualities. So we're trying to position. We think this S&P 500 is going to be 6,500 maybe by the end of next year. So we're not in a big rush to buy stocks here, and we think we'll have opportunities to buy some lower.
What do you think the market is now assuming and pricing in with regard to the trade back and forth? Because it seems as if we may end up in suspense for a little bit longer here if there isn't some kind of a broad resolution by early July.
Yeah, I think that, when these 90-day pauses expire, there'll probably be a little more volatility there. But I think the market believes that we're going to get at least some smaller trade deals, and the deals that we work out, whether we saw the UK deal, whatever we work out with China, whatever we eventually work out with the EU, that there is going to be some adjustments there. We're probably going to see some 10% tariff levels. And so basically the tariff friction is probably going to ease going forward. The unemployment rate's probably going to not go too high. We think it'll be 4.8% by the end of this year. But, I think there's some assumptions built in that might not pan out.